go. I am not social media shows. I'm produced by social media shows. What is up, everybody? Welcome back to the Russel Journal. My name is Russell, and this is my journal entry for Monday, December 19th, 2022. We're still 2022. I can't wait for next year. Got a lot of big plans for next year, so hopefully all the moons and planets and stuff align and the universe, whatever. Maybe I just act like a good guy, and do stuff that I'm supposed to do. Okay, whatever. Coming into the market this week. Okay, first of all, I want to apologize. No show this weekend. I was on the road out in LA. I will talk to you a little more about that later, but couldn't really do a show. You basically where you've come in from the market is you've had this massive sell-off on the Fed not pivoting, basically. You've got another bit of price hikes you've got more price hikes rate hikes to price into the market, and you're not really sure how much or what of that is going to break, okay? Now, the reason this matters, and matters at this point, is because the Fed, in order to get inflation down, you have to make people stop spending money, right? So the whole point of raising interest rates is to make it more expensive to borrow money to buy things. That's one thing about it. It makes it more expensive to borrow money to do business, okay? And that means prices will typically tend to have to go up, and people who live on borrowed money, they basically will have less of that. People who are running their credit cards, and I'm not even talking about a question of responsibility or irresponsibility with credit cards. There are a ton of people that I know that every month they run all of their expenses on their credit card and they pay it off at the end of the month or partway through the month. And it's a responsible way to do it, but those credits are becoming more and more expensive, and they become harder and harder to attain. Okay, so with all of that kind of being said, what happens then is people, one, they don't have money, and so, or they're not willing to fork out the credit because of the cost of it to spend, and so they stop buying things, okay? The other thing is it becomes more expensive for business owners to operate and to do stuff, so they have to basically raise prices. So the more expensive things get and the less money you have, you create this sort of division gap in there. And eventually what happens is businesses are basically forced to lower their prices to find buyers for goods and services, pretty much no matter what. So with all of that being what it is, or all that being more or less said, this is how you're trying to lower interest rates now, or lower inflation. All right. Now, what you had happen in the beginning of this year was and this is something I just learned to understand. I wrote a whole article about it on Friday and published it. It is on the Facebook page, the Russel Journal. So if you don't follow me on Facebook, check out the Facebook page. It's where I do most of the really deep thinking, and I write about it. Here you're just getting mostly just whatever I can get into words verbally. So if you are interested, just go to Facebook. I post articles on there every week, stuff I'm writing, stuff I'm thinking about, things I'm learning, and so check that out. But basically, here's what I've learned. Okay, and I learned this, and we will get into the chart and some of the chart confusion and some of the confusions in the chart. Okay, so over the course of the year, we have had this really nasty sell-off, okay? And it's more than that. That's only just what I have for today's show and to talk about. But you've got to move all the way down from the basically SPY almost 480 level or 4,800 level of the S&P. You've got that whole move down there, and you have what has happened here has been earnings compression. And my thought process on this has been really, really frustrating because I thought, why do you, it wasn't even earnings compression, it's a PE ratio compression. Why did we need to sell off, right? Unemployment is still good, earnings are still looking good, right? What was causing this sell-off that has happened? And even furthermore, it's not fear, because the VIX, go look over here. The VIX is red today while the SPY is red. So there's not a lot of fear in driving this market. We've had a few spikes up this year over 30, but it's really not been that bad. The sell-off has been orderly and organized and things of that nature. So what I learned this weekend is, and I've been sort of glassing over this as far as learning it, is really what has happened is the dollar has come up, and from the low where it was at, it's come up almost 20 cents. Okay, it's actually right around 16 cents. Okay, and now here's why this matters. All right, let's say I have, how much is a dollar worth? Okay, well, to you a dollar's worth a dollar, but to the market a dollar could be worth 95 cents. It could be worth $1. It could be worth $1.05, $1.10. It could be worth more than a dollar. Okay? So the thing is in this period where inflation is going up, or where interest rates are going up, and the Fed is also pulling liquidity out of the market, there's less dollars. That makes those dollars more valuable. Okay? You'll hear some guys like Steve Van Meter talking about something like a dollar shortage. Okay? And what you have with this thing is that the less dollars there are, it's just simply the more valuable they become. Okay, so what does that mean for stocks though? Well, when stocks are priced in dollars, right? Okay, let's say you have a dollar that is worth $1.10 of itself, and you have a stock that is a penny stock, we'll call it a penny stock, trading for $1. Well, the stock is the penny stock is worth, or the dollar is worth $1.10. So if your dollar is worth that, are you gonna just throw that 10 cents away and buy a $1 stock and just forget about that 10 cents? No. What's going to happen is you're gonna have to get that price of that stock to compensate for that extra 10 cents of that dollar. Okay, so. Wherein if you say, so think of it this way, if a stock costs $1 and I buy 10 of them, then I get 10 shares. Okay? But if my stock if my dollar is worth $1.10 and I spend 10 of those dollars, now I've made what's $1.10 times 10. Well, that's $11. So my $10 should actually buy me 11 shares. So when we talk about having a repricing of things, this is part of that process of the repricing of things. And you can even go and do the math on this, and I did it this weekend, where really when we repriced the dollar, when it came up all the way to around $1.15, right, of itself, SPY has about $86 worth of like pullback to happen just to match equity, right? So, and when I say match equity, meaning the value of the index will be equivalent to the value of the dollar, okay? Now, here's the thing that's crazy about that. As the dollar loses value, then it buys less equity, okay? So this is some stuff that I've been learning, I've been focusing on, I've been kind of really trying to catch the big picture. I'm still having some stuff moving into the bond market more and looking into that and how that whole thing works. But what you have now is you're going to have a lot of confusion about, especially things like SPY up here, okay? And the reason you're going to have this confusion about SPY and the index is because the way people talk about them from a technical perspective is the same way that you would talk about a penny stock. That is, they stand alone. Okay, penny stocks tend to stand alone. And so what's going to happen for you in the next couple days this week is you're probably going to catch an up day probably tomorrow, and there's two reasons we know this. One, the VIX is red on the same day that the SPY is red. That usually indicates within the next two trading sessions that you're going to have an up day. You're gonna catch a bounce. Okay. Now, what you're going to have here, and then the next thing that you're going to be seen talking about is these two pullback spots here and here. And what you're going to have some confusion over is there are guys who are going to be calling for an inverted head and shoulders pattern. Okay. Now, inverted head and shoulders tend to play out 60% of the time. But if you ask me, when these guys look at these charts, you are asking them to basically take a Rorschach test, and they're just inventing shit, as far as I'm concerned. Okay, first of all, a trade that happens 60% of the time, even though that the odds are above 50%, ask any options trader, anything that's got an odds of Vega of 7, right? Implied volatility of 7 or lower that's not a tradable situation for them, right? So 60% is not good odds. It's better than 50-50 and it's better than 40-60, but it's really not. But you're going to hear some guys talking about this. So we're going to talk about this sort of concept here and how this actually works. Except we're fixing my thing. Give me one second. Okay, technical difficulties. Okay, so a head and shoulders is basically a three-peak pattern where, and you can see it, say, right over here. Shoulder, head, shoulder, okay? That's it. Okay, now if you turn that upside down, you get what we're starting to develop over here, okay? You've got shoulder, head, and then you're moving over here into another shoulder, okay? And the way this works is a trading technique called measured moves. And what you're going to do is you're going to come across here and you're going to put yourself a line. See where you get the shoulder, you get the rise up. This is the first part of your neckline, kind of a rise up. And what I did is I just drew a line across these, through all of this, with some wiggle room. Normally what these guys are going to do is they're going to draw an angled line here for the neck. But you can do that, that's fine. But what you will come up with here is that you will then measure, okay? So I took this stick right here and I measured from the bottom of the head to the neckline, and then you basically just move this stick up here to where it touches the neckline, and then it comes up here to where this becomes your price target. So here's where you're going to get a lot of confusion. And this is the thing is, and especially the bond market guys, the guys who are really big in the bond market, they're pretty bullish on stocks because what they believe is that the differential between I think it's the 10-year and it's not the differential, but the inversion has reached 100 points in difference between the yield, between the bond interest rates and the federal funds rate, okay, the Fed's interest rate, okay. So right now that has been inverted, and they typically believe that when that happens, that the Fed begins their pivoting process. The problem with that is inflation. I would like to see them invert that against inflation, right? Where has inflation ever been 6% and and relative to the bond yields, right? How far inverted are you from that? Because I don't think again, they can say 100% of the time this has happened, but I can also tell you that 100% of the time, inflation's never gone back down with the Fed funds rate above or below the rate of inflation. The interest rate has to keep going up, and I guarantee you, like, Powell is literally wanting to be Paul Volcker right now. He's in this situation where he has the chance to leave the legacy of Paul Volcker. The guy's worth, like, you can Google, he's worth like $21 million. He doesn't need any more money, right? What he needs is legacy. He wants to be remembered as the guy who saved us from the pandemic, fixed inflation. We're out, right? And this is his, this is his probably last turn as Fed president. Somebody else is going to want to try and get in there. So, and imagine he wants to go and start enjoying his $21 million. So what you're going to see here, again, we're looking, so this is the way this should play out. You've got your shoulder, you've got your head. You want this price to come into into this zone right here. And, down here in the 370s, high 360s. And then you want it to bounce back up here and hit this neckline. Okay? Now, I will tell you, there's a pretty good chance of getting this far. Coming down here, coming back up and hitting that. Will it break out above that, or will it fail and continue lower? This is the question. If you're going based off of economic. Now, nobody can tell you whether it's, we can all tell you with pretty good certainty that it's going to come back up here and retest this neckline. We pretty much any trader in the world will tell you you're not going to blow through this and just keep going straight down. Okay? It's not going to happen. And part of that is because there's too many people shorting this market right now. And there is guys with big money who love to squeeze those guys. Okay? A lot of what you had, look at what happened over here and even back over here where you had these big dips down. You get these huge rallies off of it, and a lot of that was due to short covering, right? And it's really funny because if you watched Steve Van Meter's show yesterday, you'll know that Goldman Sachs, Numera, TD Securities, Morgan Stanley, they're all trying to short in the 370s, right? If you short in here, you're shorting in the hole. This is dangerous, okay? You don't want to short in the hole. And so these guys are all like, and these are some of the part of what they're doing is public. They make it very public as to what they're doing. So they're definitely looking to shorten the hole. So I'm saying, yeah, you're probably going to catch a bounce in here somewhere and stuff like that. You're probably going to come back up, check that 390 level, 400 level. That will probably happen again. And the other thing too is when we go and look at the moving averages, I'll show you they're definitely stacked in a way that demonstrates you're probably not going to get down here in the next 10 days. Okay, and you've actually only got about 7 trading days left this year. So so the low is probably in for the year. It's probably not in for the entire bear market. I'm hoping it's not in for the entire bear market. I do want to see this market continue to correct to the downside. I want to see that earnings compression, and not because I hate bulls or because I'm a perma bear or anything like that, but because we need to see those earnings come down so that we can see the inflation abate. Okay, that's my reason why. I want to see inflation come back down to 2%. I want that. Don't you want that? So in order to get that, you first have to see the earnings compression. Earnings has to come down. So it's not animosity on my thing. It's not greedy bear or anything like that. I genuinely think that until you see those earnings start to fall, we don't get to deal with the inflation story. So as far as that's concerned. All right, so this is some of the, again, this is confusion though. You're going to hear about the inverted head and shoulders. It's going to start coming up in your YouTube channel, the stuff you watch on the stock market. They're going to be talking about this. And I would say again, you're probably fair enough to play the bounce back up to here. You want to wait until it gets down towards this like 370, closer to the 370 level. But you really, again, once you get up to here, it's going to be a little bit weird. So anyways, we're going to go ahead and delete this. We're going to go through our normal rigmarole, and then we're going to end this stream for today. And we're going to take it over the daily chart. We're going to turn on our Bollinger Bands. All right. Can we zoom in a little bit there? Okay, so there's some stuff about this that is really interesting, and some of it is trading and some of it is investor stuff, just so you know. So you can see today, we're just in a straight line down. There's not a trend here, okay? You have a higher high, you have a lower low. It has been a straight line down. Now, part of what's going on is rebalancing going into the end of the year. Bonds are up, but stocks are down. So you're looking at a place where like different funds have different things for how much they have to be balanced. There are, Steve was talking about a 50-50 portfolio that have to have 50% of their money in stocks, 50% in bonds. And so they were really light on bonds, heavy on stocks. Now they're switching back over to bonds. So there's some selling off here that doesn't really care about your technical analysis. They're not shorting. They're taking profit or harvesting tax losses, one of the two. So that puts you in this spot where you're down here below this lower Bollinger Band. The deal with this, though, is your market maker's not happy down here. He doesn't like it, and he is basically setting up to like throw you back. Now, feel like okay. So so basically you're still void of trend. I've played long and short in this. I'm coming out green on both sides of it. So throughout the day, not taking big swings, one contract at a time, very, very small, minimal scalping. I think my best trade today, I'm $8.50. It wasn't really that great. So, but I'll talk more about that in a later show, what the strategy is going to cover. And this is I want to talk about this because it goes into the chart confusion. People want to just stare at this chart, invent little things within the chart that tell them what the market's going to do. That is not on the other side of this chart, on the other side of your trading, on some computer screen somewhere else, there is another asshole like me or you or somebody else out there, and they're making decisions on the chart. And the biggest guys with the biggest money have different operations by which they make those decisions. Okay? So and a lot of people are conspiratorial. It's a conspiracy with them. Listen, man, nobody's shorting this and just keeps selling and makes a profit, right? They don't know where the bottom is. They don't, right? So and even if you're the smartest hedge fund, if you're Jim Simmons, whose win rate is only 51%, right? Which is the best, right? This guy, right? Like, you got to make decisions as to where you're going to take profits. Okay. Coming into tomorrow, you got a good shot at being embedded, okay, on the daily time frame. If you like shorting this market, if you like making money on the short side of this market, right, and you think that the value of this stuff needs to go down even further, you're still coming out here, somewhere in here. Now, the good news is, if you're bearish and you like short selling, if this is embedded, you're better off. You can continue to keep short selling. Now, I'll tell you, it's kind of dumb because you can look how much money you can make either side of this. Moves up, moves down, moves up, moves down, right? You play both sides of this. You don't even have to care whether the Fed pivots or not, whether the interest is too much, whether the economy's going to crap. If you play both sides of this, you can make plenty of dough. You can make plenty of scratch. You shouldn't have an opinion about the economy, right? The only things you care about is like, well, the trend's going up, well, the trend's going down, right? So the thing is like, now, if they want to stay bearish and they want to keep holding, you keep that embedded reading. Okay, you get this in here for 3 days. You stay below 20 for 3 days, and you're all right. Okay, but the thing is you're oversold. You're underneath the lower Bollinger Band, and you have a chance at maintaining your embedded reading, even if you start to take profit. And this is a good win, man. You went all the way from what? From 410 all the way down to, we hit 378 today, just above 378 and change. So that's a pretty solid trade, The $31, you should be probably thinking about if you manage to short and hold that position short all the way into day, probably some time to take some money off the table. So, especially because you're down here, and because why make the same money twice? So you're not going to lose your embedded reading if you get a short covering rally into the open tomorrow, into the first 4 hours. You'll maintain your short, even if you get some short covering into the last 4 hours. And I would recommend you watch SPY on the 4-hour chart tomorrow and see what happens. If you keep getting this pressure, this selling pressure into here, you could be looking at, now that's the thing. You could be looking at getting to your capitulation type move, but again, none of us can trade on capitulation, right? That's not a thing. That's a random event. Okay? So if you're trading hoping for capitulation, God help you, because you're not trading, you're gambling. Okay? Anyway, so we're really looking for some short covering to happen tomorrow. Scalp some bounces off of that, more or less. Also look to get you're hoping for that because you really need that bounce. You need them to cover so that you can get a decent short position. Again, my trade wins are like $6 and $8 right now. So it's not a lot of money I'm making. But you need that bounce so that you can bring more bears in to make more money on the downside if there is more downside. And this is going to give you even more chart confusion going on, because the minute you get the bounce, what are they going to say? Oh, it's the Santa Claus rally. Santa's coming to town. It's going to be a green, right? So even then, it may not hurt to play the long side of this on that green day when it shows up. So anyway, that's going to do it from me. The Russell Journal, written, edited, hosted by me, Russell List. We're produced by Social Media Shows. Executive producer is Maria Pereza. Anyway, check out Social Media Shows if you want to do a show like this. And until tomorrow, just pretend I said some sort of catchphrase.